What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. About 1 year ago, market observers started noticing unusual price activity in a number of media and technology stocks. For example, Viacom's share price more than doubled in a matter of a couple months, despite the company not reporting any meaningful news. As it turned out, all of this unusual price action was caused by one man, billionaire investor Bill Hwang. Hwang made his fortune by running a successful hedge fund, which he eventually turned into a family office called Archegos Capital Management. His success as an investor came from both his stock-picking acumen as well as his willingness to take on excessive amounts of leverage. Archegos' capital swelled from $1.5 billion in March of 2020 to $35 billion going into 2021. He took on 4.5 times leverage to buy $160 billion worth of shares in Viacom CBS, Discovery, Baidu, and a few other technology stocks. This was enough for him to single-handedly pump up the prices of these massive companies. He was playing a high-risk game of Jenga with $160 billion on the line. Eventually the bubble popped and the stocks that he pumped up all came crumbling down. Archegos' portfolio was completely wiped out and its lenders suffered over $10 billion in losses as well. These lenders were some of the largest banks on Wall Street, including Credit Suisse, Morgan Stanley, and Goldman Sachs. At first, people thought that this guy must have gone crazy. It was as if a degenerate from Wall Street Bets somehow got a hold of $160 billion and tried to blow it up as spectacularly as possible. But now we have new information. Hwang was not crazy. As a veteran of the hedge fund industry, he knew exactly what he was doing. His pumping up of stock prices was no accident. According to a recently released criminal investigation, it was part of a highly sophisticated market manipulation campaign, which lasted for almost a year. If he was just a little bit luckier, he could have stood to make tens of billions of dollars in unethical profits. After conducting a year-long investigation, federal authorities have arrested Hwang along with 3 of his associates, and he now faces up to 80 years in prison. In this video, we'll look at how Hwang was able to take on so much leverage, how he allegedly tried to manipulate the markets, and how it almost worked. This video was brought to you by Privacy.com. Privacy lets you buy things online using virtual cards instead of having to use your real ones. It may seem like every product or service is promoting offers for customers to sign up for a free trial at this time of year. You might be tempted to sign up, but they intentionally make it as difficult as possible to end your subscription. If you don't cancel in time, they automatically start charging your card. With Privacy.com, the days of jumping through customer service hoops or losing money on apps you never meant to spend on are officially behind us. You can generate a one-time card number that can be used for signing up for these trials anonymously, which you can then close on your own terms as soon as it's gone through. And it's super easy to make an account. We can do it right now. Click the sign up button, connect your funding source, link it to your US checking account or debit card, create a virtual card, and set a limit for how much it can spend. For added convenience, you can download their extension from the Chrome web store. Protect your identity by going to privacy.com/WSM and sign up for an account. New customers will automatically get $5 to spend on their first purchase. Go to privacy.com/WSM and sign up now. And now back to the video. Using leverage to increase investment returns is nothing unusual. Even as an individual investor, you can buy stocks on margin. Depending on your brokerage, you might be able to take on 50 to 100% margin. If the stocks you bought go up, your gains will be amplified by the leverage. On the flip side, if there's ever a market crash, you can be completely wiped out and your portfolio value can go negative. This hypothetical graph shows the performance of a leveraged portfolio. Most brokers only allow you to take on at most 100% margin, which gives you 200% exposure. If your stocks fall by 25%, your portfolio will fall by 50%, which is pretty bad, but at least you're still positive. Hwang took on 450% leverage. A 25% drawdown in the underlying stocks would result in the portfolio losing more than 100% of its value. For this very reason, no broker would give you such an obscene amount of margin. So then how was Bill able to convince his brokers to let him do it? Archegos had 9 different counterparties that it used to take on leverage. These counterparties were large investment banks including Goldman Sachs, Morgan Stanley, Credit Suisse, and others. Each one made a risk assessment to decide how much they were willing to lend and how much collateral they required. Each counterparty only saw what positions Archegos held directly with them. For the risk assessment, they needed to know Archegos' total exposure across all of its brokers. Archegos refused to disclose the positions held at other counterparties, but they reassured the banks by saying they were prudently managing the position sizes. Importantly, they said that their portfolio was highly diversified, which makes it less risky. For example, let's say they own $5 billion worth of Viacom stock at Credit Suisse. They would say that their positions with the other banks were in different stocks. So maybe you use your Credit Suisse to hold your Viacom shares, Goldman Sachs to hold your Discovery shares, Morgan Stanley to hold your Baidu shares, and so on. While positions at each bank were concentrated, the overall portfolio was diversified. Of course, this was all an elaborate lie. They would hold the same stock at multiple different banks, so the total position was many times larger than each bank thought. They said their single largest position was equal to 35% of their capital. In reality, Viacom accounted for 96% of their capital. They also said that they would be able to liquidate the entire portfolio within 2 weeks if necessary. This is calculated by selling 15% of the average trading volume per day. Selling any faster than this would adversely impact the share price. This representation couldn't be farther from the truth. Their position in the Chinese e-commerce company Vipshop was so big that it would take 134 trading days to complete an orderly liquidation. That means that if the bank had to liquidate the position quickly, the selling pressure would cause the stock price to collapse and incur catastrophic trading losses. And finally, they told UBS that their positions at other banks were in large, liquid megacap stocks like Amazon, Apple, or Google. In fact, these megacap tech stocks made up only a negligible proportion of their portfolio. Their misrepresentation successfully made a false impression that they had a well-diversified portfolio in large liquid stocks, which was the exact opposite of the truth. However, there was one problem. When you own more than 5% of any company's outstanding shares, this triggers a disclosure requirement. At the peak, Archegos owned more than 50% of Viacom's free float. If the bank saw this disclosure, they would see that the portfolio is far less diversified than he claimed. So Hwang had to get more sophisticated with his deception. He used something called a total return swap. This gives Archegos the exact same economic exposure that they would have if they owned the shares. But the bank owns the shares on their behalf. It'd be like if I gave you $1,000 and told you to buy shares of Apple. At the end of the year, you'll sell the shares and give me the proceeds of the sale. For practical purposes, I own the shares, but they're technically under your name in your account. If you look at the top holders of any given stock, you'll often see investment banks like Goldman Sachs or Morgan Stanley. In many cases, they're holding these shares on behalf of their clients, so you have no idea who actually owns it. That's exactly what Archegos did. By the summer of 2020, Hwang successfully duped the banks into giving him an insane amount of leverage. All that was left was devising a trading strategy to 10x his money. In the past, Archegos used a fundamentally driven investing strategy. They had dozens of research analysts who would analyze the financials of various companies. They had frequent meetings where the analysts would give buy and sell recommendations to Bill based on their research. But starting in 2020, he completely changed his strategy. He identified about a dozen stocks with relatively low liquidity. Once he identified these stocks, he went all in and didn't even consider new positions as analysts recommended to him. The strategy was pretty simple. He would start buying shares in these companies day after day, flooding the market with buy orders. Because he had so much leverage capacity from the banks, he could single-handedly pump up the prices, which increased the value of his portfolio, at least on paper. He would be on the phone with his trading team pretty much all day every day, devising strategies to maximize the price impact. They would buy heavily into the close to make the closing price high. When you look at stock charts, they often use the closing price for each day. This adds to the illusion of the stock having positive momentum. He would also add buying pressure in the pre-market where volume is very low. With a relatively small amount of money, you can pump up the price in the pre-market. Other market participants look at the pre-market strength and assume there's some sort of good news about the company. This is called setting the tone for the day, and is one of the oldest tricks in the book. Whenever there was bad news about one of his positions, he would instruct his traders to aggressively buy shares to prevent the price from declining too much. This creates a false impression that the news is not that bad. This was especially relevant for his position in the Chinese online education company GSX, which became one of his largest positions. In May of 2020, the famous short seller Carson Block came out saying that GSX was a near total fraud, with 80 to 90% of its customers being fake. Initially, the stock was down a few percent as investors got scared and started selling. But within a few months of the short reports being released, Bill Hwang started building up a multi-billion-dollar position in the company, eventually owning more than 50% of the shares outstanding. This helped to pump up the price to over $100 per share at the peak. It's hard to speculate exactly why he did this, but according to a recently released indictment, Hwang was already ignoring his research analysts by this time. His reasons for going all in on GSX were likely more technical in nature. You might remember the epic GameStop short squeeze that happened in early 2021. Whenever you have a stock with very high short interest, an increase in buying pressure can cause a short squeeze, which pushes the stock up towards the moon. GSX was in a similar situation. After Carson Block's short report, other hedge funds started piling in as well, and the short interest increased significantly. Hwang likely smelled blood in the water and thought that he could cause a squeeze. While Carson Block always believed that GSX was a fraud, he says that he was forced to cover some of his position as the stock was skyrocketing in the summer of 2020. He said it looked like a consortium of hedge funds were pumping up the price to profit from the eventual short squeeze. The indictment against Hwang does say that Archegos conspired with another hedge fund who was also buying shares in GSX. While we don't know for sure, it's widely believed that this other hedge fund was Tiger Global, run by fellow billionaire Chase Coleman. Interestingly, Hwang and Coleman both worked for the legendary hedge fund Tiger Management back in the 1990s, so their connection goes back decades. And based on regulatory filings, we know that Tiger Global was a major shareholder of GSX at the same time that Hwang was buying his stake. With $95 billion of assets under management, Tiger Global is one of the most successful hedge funds in the world. It would be interesting to see if the Department of Justice brings any charges against them in connection to Bill Hwang's market manipulation. Hwang's strategy of pumping up stock prices worked extraordinarily well in 2020. He increased Archegos' equity value from $1.5 billion at the beginning of the year to $35 billion by the end. That's more than a 20-fold increase and shows the power of leverage, at least when times are good. With an 11-figure net worth, Hwang was one of the richest people in the world. For all practical purposes, it would be impossible for one man to spend this much money in his lifetime. He could have called it a day and retired. But that's not the type of person that Bill is. If you 20 times your money in 1 year, why stop there? A couple more good years and he could be the world's first trillionaire. Going into 2021, he used the higher equity value of his portfolio to get even more leverage from the banks, ultimately amassing a $160 billion portfolio. Hwang used this money to triple down on Viacom-CBS, which has since changed its name to Paramount Global. He bought up 50% of the outstanding shares, which at the time was worth tens of billions of dollars. The buying pressure pushed the share price up 160% in almost a straight line. Viacom's senior management team had no idea why their stock price was skyrocketing. They thought it was highly unusual. They decided to take advantage of the elevated valuation to issue $3 billion of new shares. The stock sale signaled to the market that even the executives at Viacom thought that shares were overvalued. Viacom shareholders started dumping their stock to take profits. Hwang instructed his traders to use all the remaining cash and margin capacity to buy more shares of Viacom to prevent the decline. Employees at Archegos grew concerned that they wouldn't have sufficient funds to pay for the trades and raised this issue with Bill. Bill said not to worry about it and continue buying Viacom. This had always worked in the past. But by this point, Viacom had gotten to be so outrageously overvalued that a huge number of investors wanted to take profits. Archegos withdrew all the money that they could from other banks to deposit into the banks which held Viacom positions, thereby putting every single one of their accounts in critical condition. But even this was not enough. They simply ran out of cash. Once they stopped buying, the price started to freefall. All of the banks immediately started liquidating all of his positions simultaneously, causing a massive crash in all of their prices. In just a few days, $100 billion of combined market cap was wiped out, and Archegos was completely ruined. All of Archegos' brokers lost money from the incident, but Credit Suisse was by far the hardest hit. They suffered a $5.5 billion loss, which is the single largest loss from a margin default in the Swiss bank's 150-year history. Credit Suisse's share price has lost 50% of its value since Archegos imploded. Investors now doubt their internal controls and risk mitigation procedures. The story of Bill Hwang is a cautionary tale of greed. For some people, no matter how much money they have, it's never enough, and they're willing to do just about anything to see the value in their bank account go up. Alright guys, that wraps it up for this video. What do you think about Bill Hwang? Do you think he deserves jail time for his insane investment strategy? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.